BHP just reported something that hadn't happened in the company's modern history. For the first half of fiscal 2026, copper overtook iron ore as the single largest earnings contributor, at 51% of total earnings, or $8 billion in 6 months. That is not a rounding error. That is a structural shift in what BHP actually is. The market has spent years treating BHP as an iron ore proxy. The share price moves when Chinese steel demand data moves. The analyst notes lead with Pilbara shipment volumes. But the earnings composition no longer supports that framing. BHP is now, by its own financials, primarily a copper company that also mines iron ore. That gap between how the market prices BHP and what BHP actually earns is where the tension lives. And it matters because the two commodities are facing completely different demand trajectories right now. Iron ore is sitting at $107 per ton. That is up from $99 a year ago, so the headline looks constructive. But the forces pressing against that price are structural, not cyclical. Chinese markets reopened, and iron ore edged higher. Yet analysts immediately flagged that China's property sector weakness and soft steel demand outlook have not resolved. US-China tariff escalation adds a second layer of complexity on top of that. Fortescue is the company most exposed to that pressure. Unlike BHP, Fortescue's revenue base is almost entirely iron ore. Its strategic response has been to accelerate decarbonization of its Pilbara energy grid. CEO Dino Otranto, framing it not just as an emissions decision, but as a hedge against energy cost exposure tied to Middle East instability. That is a defensive posture, not a growth one. Copper tells a different story. At $12 $360 per ton, copper is up 42% over the past year. BHP upgraded its copper production guidance to between 1.9 million and 2 million tons, citing record output at its Escondida mine. Escondida is the world's largest copper mine. A production record there is not a minor operational note. It shifts the volume base for BHP's highest margin segment. The divergence between these two commodities is now embedded in BHP's income statement, which means a China demand shock and a copper demand surge can happen simultaneously, and BHP partially absorbs both. Goldman Sachs has copper's 2026 fair value at around $11 100. The current price is above $12,000. That gap is not a minor variance. It suggests the copper market has run ahead of where the fundamentals justify it, at least by Goldman's framework. Their severely adverse scenario, a 1.2 percentage point drag on global GDP, would pull copper below $11,000. That scenario is not the base case. But it is not a tail risk either, given that US-China tariff escalation is already in motion and Middle East energy disruptions are live. Here is the point most people are missing. The same geopolitical stress that is lifting copper prices through supply chain anxiety is also the scenario that, if it deteriorates further, collapses the demand side. Copper's current premium above Goldman's fair value is built on constrained supply. But Goldman's downside is built on demand destruction. Those two forces are not independent. They are on a collision path if the macro deteriorates fast enough. BHP stock is up over 53% in the past 12 months. Some of that is deserved. The earnings quality genuinely improved. Profit after tax, up 28%. Dividend up 46% to US 73 cents per share on a fully franked basis. But a meaningful portion of that re-rating reflects copper optimism that is now priced above Goldman's base case. That overhang does not go away quietly. There are two forces providing a floor under BHP's operational performance that do not show up in commodity price charts. The first is the AI deployment on iron ore infrastructure. BHP is placing around 50 AI-powered cameras across its conveyor belts and crushers, with full deployment targeted by July. The chief technical officer has attributed $50 million in additional iron ore revenue over the past year to early fault detection from this system. That is not transformational at BHP's scale, but it represents a new class of operational leverage, one that compounds if the camera count scales and the detection algorithms improve. It also means iron ore revenue has a marginal upside buffer that is independent of spot price. The second is the avoided Pilbara labor disruption. A union had planned overtime bans involving up to 50 high-voltage power workers at BHP's Pilbara sites, the first industrial action threat in that region in decades. BHP successfully fought off that action. The significance is not just the avoided cost. It is that Pilbara operational continuity, which the market treats as a given, came closer to being disrupted than at any point in recent memory. Fortescue's path forward hinges almost entirely on whether China's steel demand stabilizes. If Beijing deploys targeted infrastructure stimulus, which remains its historical playbook when growth softens, iron ore demand could recover faster than the current sentiment implies. Fortescue would benefit disproportionately in that scenario, precisely because its revenue concentration in iron ore is currently its liability. The evidence leans toward BHP holding up better through near-term turbulence, but only if copper does not give back its premium sharply. The recovery path for Fortescue runs through Beijing, not through anything Fortescue can control operationally. Both paths exist. Neither is foreclosed. BHP crossed a threshold in H1 FY 2026 that changes the analytical lens permanently. It is no longer appropriate to model BHP primarily as an iron ore company with copper upside. The earnings composition has inverted. The company is now a copper company carrying iron ore exposure, and the market has not fully repriced that distinction. That repricing, when it comes fully, cuts both ways. It makes BHP more valuable if copper holds above Goldman's base case. It also makes BHP more vulnerable to a copper correction than most iron ore-focused analysts are currently modeling. The commodity that saved BHP's earnings mix is now the commodity that carries the most valuation risk.